It is my pleasure to welcome you to this seminar organized by the Research Department of the IMF on monetary policy frameworks. Now, with the inflation environment changing fast globally, central banks are being challenged to restore price stability without plunging the global economy into a recession. Key to this effort is the way central banks can shape inflation expectations. Monetary policy frameworks are at the forefront of the discussions now more than ever. Having a well-structured policy framework based on operational independence, transparency, a coherent strategy, and effective communications is absolutely crucial to deal with uncertainty and major shocks, like the ones we have been going through recently. The war in Ukraine, and of course, the pandemic and the surge in inflation that resulted. It provides a frame of reference that ensures sound and consistent policymaking that helps the public form policy expectations and ultimately improves monetary policy effectiveness. Along these lines, we have recently seen several central banks, including the Fed and the European Central Bank, revising their own monetary policy frameworks to be better prepared to tackle current challenges, while also setting up the conditions for future changes. A metric that can fully capture the complexity and evolution of the monetary policy frameworks is therefore of the utmost importance. We have invited a great group of experts to discuss these issues today. Let me introduce them. First, David Wessel is the director of the Hutchins Center on Fiscal and Monetary Policy at Brookings. David has been following the evolution of monetary policy for many years, and I can't think of anyone better to moderate this event. Alan Blinder is a Gordon Rentschler Memorial Professor of Economics and Public Affairs at Princeton University and former Vice Chair of the Federal Reserve. Alan is an absolute pioneer in the field of monetary policy. And I remember fondly the time, not so long ago, or so it seems, when Alan and I were colleagues at Princeton. Richard Clarida is C. Lowell Harris Professor of Economics and Professor of International and Public Affairs at Columbia University, and also former Vice Chair of the Federal Reserve. Richard was a key architect of the recent revision on the US monetary policy framework. He needed to join the event with a video, but we nonetheless are looking forward to getting his views on this topic. David and Alan, it is a privilege to have you with us. I'm confident we will have an extremely engaging conversation. Before I pass it on to David, let me also thank Chris Papageorgiou, Filiz Unsal, and their team in the research department for this work putting together this seminar. We are also releasing today the related comprehensive index of monetary policy frameworks, a very much needed public good everyone can benefit from. With that, I hand it over to you, David.
Good morning, and thank you all. It's a pleasure to be here and to participate in the inaugural bringing people in person to an event at the IMF. I hope it's the first of many, but we're glad that technology allows us to have remote participants, not only Alan Blinder, but others. So the program this morning is Filiz Unsal is going to go through and discuss each of the 225 criteria and why she decided to assign 0 to some and point to others and 1 to others. And after she gets done with that, no, seriously, she's going to present her work. And then we have a brief video from Rich Clarida, who unfortunately can't be with us today. And then Alan Blinder is going to make a presentation. He has some slides. And then we'll engage in a conversation. I hope that we can engage the people in the room as well as the people remote on WebEx, and you know how to ask the questions, and I'm hoping I'll be able to figure out what they are. So with that, Filiz, the floor is yours.
Thank you. Thank you, Pierre-Olivier. Thank you, David. So it's really a great pleasure to have all of you in the room, and of course, Professor Blinder with us today. I also would like to thank Richard Clarida in advance for his discussion, and of course, David for being with us today. It's a great pleasure to present this work that we have been investing a lot of time and effort. When David said 225 criteria, that's actually right. So this is a joint work with Chris Papageorgiou and Andre Garbers. And before proceeding, I should say that the views I will express today do not represent the views of the IMF, its executive boards, IMF management, or of the FCDO. So we tend to think monetary policy in terms of setting a policy tool that is usually the interest rate in accordance with some sort of policy objective, typically inflation. However, there are so many other elements of monetary policy that matters in terms of specific design, implementation, and communication issues, as well as legal elements that play a lot of role in the effectiveness of monetary policy. So, as opposed to standard textbook definition, monetary policy is indeed very complex and evolving, and its effectiveness requires a clear, reasonable, and unified framework. Global financial crisis and the COVID-19 pandemics and afterwards have brought numerous old and new elements to the forefront of the monetary policy debate and tested policymakers to their limits and pushed monetary policy practices and thinking even further as our understanding of the economy and policy evolve. So with this project, we aim to capture this complexity of monetary policy by painting a very rich picture of monetary policy making across countries and over time. Monetary policy frameworks incorporate the structures in place that enable and guide the conduct of monetary policy. Specifically, we think of monetary policy frameworks consisting of three pillars. Independence and accountability provide foundations for monetary policy. Policy and operational strategy define the settings of the policy stance given the objectives and numerical targets and specifies how the changes in the policy stance are implemented. And finally, communications convey policy decisions and their rationale to the public. Together, these pillars provide a complete description of monetary policy frameworks. There is, of course, an extensive literature behind each pillar, and I am sure many of you are very familiar with, especially in this audience. As you know, Ben Bernanke and Alan Blinder contributed immensely to this literature, and of course, Adam Posen and others on independence and accountability. We indeed draw on this literature to further delineate pillars along their conceptual constituents to allow for the sharpest characterization of information. For example, under policy and operational strategy, we look at the explanations of objectives and numerical targets, what are the tools of monetary policy, how the monetary policy is formulated based on these objectives and numerical targets, and how they are implemented. Indeed, each pillar and sub-pillar capture a unique perspective of these features within the YAPOC metric. For example, in terms of numerical targets, independence and accountability, you see the sub-pillar number 2 captures governance arrangements regarding the setting of numerical targets. For example, who sets the numerical targets or how frequently they could be changed. However, policy and operational strategy, here in the sub-pillars you see in number 2 and 4, capture the actual specification of numerical targets and their revisions and how they guide policy formulation. In turn, communications in sub-pillars 2 and 3 captures how the numerical targets feature in policy decision announcements and monetary policy reports. To cover all these pillars and their interactions thoroughly, we design a granular set of criteria. Using public information collected manually from central banks, laws, and websites, we then provide the YAPOC index for a heterogeneous group of 50 countries over 2007-2018. With this index, we can capture various key patterns across countries and over time about their monetary policy frameworks, as well as their pillars and sub-pillars. As we consider the comprehensive monetary policy frameworks, we complement the earlier literature that focus on some elements of monetary policy frameworks, such as the existing central bank independence or transparency indices. But the significance and novelty of our work is that we focus on the encompassing monetary policy framework with joint consideration of policy and operational strategy and communications, as well as de facto and de jure independence and accountability. This goes well beyond the more simplistic ways of differentiating monetary policy across countries based on whether they have an inflation target or they adopt an exchange rate management strategies. So in that sense, we do actually challenge a bit the existing paradigm based on the classification of countries' monetary policies in terms of the regime classification as well as the exchange rate classification towards something that is more thorough. So in the rest of my talk, I will go through the methodology behind the YAPOC index, the data collection and scoring, and then I will present the index with some findings. So moving to the methodology, in total, we have 225 criteria for each country, reflecting the comprehensive characterization of monetary policy and the rigorous nature of our exercise. For example, you may ask whether a country has a numerical target on inflation, but this numerical target may not mean anything if it is not clearly defined and it may be changed on the fly. Our criteria are designed so that the answers are self-evident and mutually exclusive to ensure the objectivity as much as possible. We also use the same criteria and the specific public resources across countries. For example, the exact criteria for numerical targets under the policy and operational strategy and communications look like this: yes and no binary answers. So here you see that under the policy and operational strategy, under numerical targets, we have various questions that corresponds to that are objectively answerable looking to these public resources. In turn, in the communication of the numerical targets, we have a similar criteria that aim for exactly looking to how numerical targets are communicated to the public. So the gradual criteria for each pillar are anchored around by three axioms that are transparency, referring to clarity and availability of information, coherence, reflecting features that are unequivocally desirable or reflect consensus, and consistency across pillars in terms of objectives, numerical targets, and tools. This is meant to capture that effective monetary policy requires a coherent and unified framework where the policy formulation, implementation, and communication are in sync with each other. Going back to the example of numerical target, there will be the transparency that would only capture whether there are numerical targets. But this is not sufficient. In order for numerical target to be effective, the policy formulation and communication should also be centered around these numerical targets. And moreover, whatever is communicated in the communication must be consistent with the ex-ante policy strategy. So with these axioms in the criteria in the metric, we actually, for each criteria, there's an axiom associated with it. So when you look at the numerical targets in policy and operational strategy, you see very clearly what axioms are related to transparency or coherence. And as I mentioned before, we also ensure consistency in these axioms. For example, in the communications, you see that there's a specific criteria on whether the communicated numerical targets are in line with what is stated in the strategy. So in the YAPOC metric, we also capture independence and accountability in a comprehensive and granular way. First, we focus on monetary policy as opposed to central bank functions, which may include, for example, financial stability, but for which central banks may not be afforded the same type of independence and accountability. Moreover, we consider independence in the context of accountability. While central banks remain public institutions, they often fall outside of the standard system of checks and balances because of afforded independence. However, ensuring accountability to the legislator and society at large helps to safeguard the legitimacy and sustainability of independence of monetary policy. And as I mentioned before, we consider both de facto and de jure elements. For example, for the monetary policy making body, we check both by law and by practice how it is structured. So you see in the exact criteria here, we can see what are how we define the monetary policy making body, and you will see that for almost each criteria on the de jure term, there's a de facto element that we go and check the resources. To assess the criteria, we manually collect information from public resources at the end of each period, except for communications, which is assessed for the whole assessment year. Our main source is archived websites and central bank laws. There is often also a dedicated document for policy and operational strategy, which we will tap. And of course, for communication, we use all the information in monetary policy press releases, decision announcements, and monetary policy and inflation reports. In terms of scoring, the overall index is calculated as an unweighted average of all pillars, and each pillar is composed of its sub-pillar, which are then calculated as the average of the relevant criteria. So now we can move to the index and how it looks. The graph on the left shows that the YAPOC index for advanced economies, emerging markets, and low-income developing countries over time. You see that there's a large variation across country groups, while advanced economies generally score higher. But the gaps between countries have been narrowing down, with emerging markets and low-income developing countries strongly improving their monetary policy frameworks. On the right side, you see that all the pillars across country groups for 2018, which is our last assessment year. Overall, low-income developing countries, at least the one in our sample, on average, are not that far from emerging markets for all the pillars. Across the pillars, cross-country variation is much higher for policy and operational strategy, as well as communications, which are assessed and looked at for the first time within the YAPOC index. Indeed, most of the time variation also comes from these pillars. In this slide, each country group is represented by a triangle with pillars in each corner. The lines represent 2007 and 2018. You see that most of the change comes from communications in advanced economies, policy and operational strategy in emerging markets, and communication in low-income and developing countries. Thanks to the granular nature of the exercise, we could gain some further insights on what specific elements of monetary policy frameworks have been improving and what are the remaining challenges. As an example, in the next slide, we show how different sub-pillars change over time. Can we change the slide, please? You see that the big jumps come from mainly how they refine their tools and implementation. There are also enhancements in announcing and explaining policy decisions. When it comes to independence accountability, although there are some changes, these are mainly reflected in the de facto changes, although we don't show it here. And also, there are still remaining challenges, as you see that the scores below, on average, in emerging market economies, remain around 0.6 for all the pillars. And these challenges are reflected, some other challenges are also reflected in these graphs. For example, the tools used in practice in emerging market economies sometimes do not match with the ex-ante exposition of policy formulation. Even if they match, sometimes it's not explained how these different tools are related to each other or jointly balanced within the monetary policy framework to achieve the objectives and numerical targets. This further showcases the importance of a comprehensive metric that enables to look at monetary policy making across countries, including those that adopted more eclectic approaches. In this sense, the YAPOC index challenges the conventional wisdom that focuses solely on few elements to understand how monetary policy is conducted, such as existing monetary and exchange rate regime classifications. Here, we put the IMF Arrear monetary policy classification next to the YAPOC index. Each row represents a different country, and each shade represents an increment of 0.05, so 5%, given that our upper bound is 1. You see that there are many cases that share the same regime across countries when we look at the monetary policy regime classification. However, they do vary greatly in terms of how they conduct monetary policy, as picked up by the YAPOC index in the colored zone. Even in countries, among countries with the same regime, such as inflation targeting in the first one, there's a great variation across countries on the soundness of their monetary policy framework, as measured by the YAPOC index. In addition to that, focusing only on monetary policy regime classification neglects the dynamic variation in monetary policy frameworks over time. For example, while IT countries do on average score better, improvements in monetary policy frameworks actually precedes the switch in the regime, as you can see on the right side. Similar to monetary policy regime classification, exchange rate regime classifications are not good proxy for monetary policy making either. Interestingly, we show that having a more or less flexible exchange rate regime doesn't seem to imply necessarily a better or worse YAPOC score. For example, in the advanced economies, the distribution of YAPOC index for countries with less flexible exchange rate is almost identical to that of countries with a more flexible exchange rate. Even in EMs on the right side, despite countries with more flexible exchange rate on average obtain a higher score, there is still a large overlap between the YAPOC scores across countries with more or less flexible exchange rate regimes. This may be a more relevant feature for emerging markets and low-income countries, but the YAPOC could also pick up less silent features of monetary policy frameworks in advanced economies as well. As you may be aware, there were recent revisions in monetary policy frameworks in the US and in the Euro area, so we updated the index for these two cases for 2021. You see that there were big improvements in the policy strategy and communications in both cases picked up by the YAPOC index in 2021. In particular, there was the revisions capture conditions under which monetary policy frameworks can be revised, and this time around they set conditions on how numerical targets can be revised. Balancing of the multiple tools to achieve the objectives and numerical targets are also clarified, particularly in the new framework of the Fed. There have been also improvements in communication of the outlook and risk to the outlook in the policy announcements as well as monetary policy reports. And more broadly, there's an effort to communicate to a broader public for both central banks in the new frameworks. And finally, in this presentation, and given that ultimately monetary policy frameworks play a role in managing inflation expectations and all the debates right now around the increases in inflation, we checked the association of the index with inflation expectations and outcomes over the medium term. The correlations are always negative and significant at around 0.6. You see that in the first row, we have the YAPOC, in the column, we have the YAPOC index, and then we have independence, accountability, policy and operational strategy, and communications. The association is indeed particularly strong for policy and operational strategy and communications pillars, perhaps as expected. We also check some other metrics of inflation expectations, such as Stockholm-Watson and others, and this negative relation between the YAPOC index and inflation expectations is retained. Now, even in the latest episode, Country variation we observe seems to be related with how they conduct monetary policy. For example, in the changes in the inflation expectation in consensus, which only covers 35 countries, so at the bottom we complemented that with our view projections on inflation, you see that the inflation changes since the COVID period between Q1 2020 and Q1 2022 have been negatively correlated with the YAPOC index, especially with policy and operational strategy and communications. So, of course, we will need to establish a more robust link between monetary policy frameworks and inflation expectations, and we will pick this up in the future work. But today, we are also launching the associated data on the YAPOC index so that the other policymakers and researchers around the world can also take a look and play with the data. The data is indeed already available at www.data.imf.org/MPF. Despite our efforts, of course, there are several reasons to be careful when using this data. For example, we manually collect the data from online and public resources. Nevertheless, given the novelty and the depth of this exercise, we hope that people find this data useful. Thank you, and I stop here.
Thank you very much, Filiz. Can I ask just one question?
Sure.
How long did it take to put this together?
5 years.
5 years?
Yes.
Wow, it's impressive. Okay, so I've managed to get on WebEx, so if people have questions, they can put them in the Q&A on WebEx, and I can read them on my phone. But why don't we show, Rich Clarida, of course, is the vice chairman of the Fed when they revised their framework. Unfortunately, he's not with us, but he has a short video. So we're going to play that now, and then we'll be, you're pointing, they're going to play it. Yep. We're going to play the video now. Can you? Okay, we have no audio. Okay, let's try again. If not, I have the text. I could probably read it.
This paper on monetary policy frameworks by Filiz, Chris, and Andre, and I'm pleased to do so. The paper summarizes the methodology and key findings of a larger IMF project on central bank frameworks. It's excellent and reflects an enormous amount of effort by the authors and the IMF staff to assemble and organize a huge and detailed granular database on the evolution of central bank frameworks across 10 years and 50 central banks. Now, huge granular databases are of limited value in the absence of a coherent and consistent organizational architecture. And it is here that the project shines. Briefly, the authors lay out in Table 1 an architecture with 3 pillars, each of which is supported by 5 sub-pillars. The pillars on which a framework stand are the ones you would expect from the modern literature on central banking. Goals, which they label independence and accountability, strategy, and communication. For example, a central bank can be accountable for price stability. It can have the instrument independence to select inflation targeting as a strategy to achieve the goal, and it can communicate the rationale for its policy decisions under the strategy to achieve its goals. So far, so good, but it's the next step in the project that involves all the work and that produces a remarkable data set that, if regularly updated, will, I suspect, prove to be invaluable to policymakers and students who study monetary policy. The index for each central bank in each year is constructed from the scores on 225 criteria, most of which are coded as 0-1, and each of which corresponds to one of the 15 sub-pillars. The appendix to the paper, starting on page 37, provides a detailed description of each of the 225 criteria, organized according to pillar. I will not, in attempt in my allotted time to discuss these in depth, other than to say that the criteria cover a lot of ground and certainly include the ones that came to mind as I was reading the paper. One comment on the criteria I will offer before discussing the results is the pros and cons of allowing for non-binary scoring of the criteria. Although the authors predominantly stick to 0-1 scoring, there are some cases which allow for 0, 1/2, and 1 scoring. For example, criteria 4.1.3.1, quote, is the central bank prohibited from buying government securities in the primary market, allows for a score of 1/2. Now, I'm not sure why this question is harder to score than any other criteria that must be 0 or 1. More importantly, one hope or desire I would have as the framework evolves is that the IMF resists the temptation to award partial credit across a large number of criteria. I might suggest that, in fact, the IMF stick entirely to binary classification and leave to others, including central banks who may not be happy with their scores, to offer their own analysis of how they should be scored according to the binary classification. The main results in the paper are reported in Table 3 and Figures 3 to 8. There's a lot here, so I will highlight a few. On the independence and accountability pillar, the average scores for advanced and emerging economies differ by only a modest amount, whereas the differences on the strategy and communication pillars are on average wider. That said, the trend since 2007 is for the gap in scores between advanced and emerging economies to narrow. The results are similar for the associated sub-pillars. Table 4 provides a cross-check by reporting correlations between the author's INA index and the well-known Kukerman et al. Index. Interestingly, it shows that the IMF index based on de jure criteria for independence and accountability is more correlated with the existing index than is the calculation based on the de facto criteria. There's a lot more in the paper, including a very interesting chart that shows that after emerging market economies announce inflation targeting, that their scores on the strategy criteria rise discreetly and significantly. But there's a lot that other policymakers and academics can, and I think will do with this data set. The authors give one example in section 6 by relating the cross-sectional variation in their index to exchange rate regime classifications. One other example that comes to mind is how their index correlates and evolves over time with the macro-prudential responsibilities that many central banks in the sample have undertaken since the global financial crisis. In closing, this is an important research program that is well conceived and executed and which provides a new data set that will be of value to policymakers and students of monetary policy frameworks for years to come. Speaking for myself, now as a student of monetary policy, I will be developing a new course at Columbia next spring on global monetary policy in the 21st century, and plan to devote at least one of my lectures to the findings of this paper. Thank you, and again, my apologies for being in transit during this session. Thank you.
Thank you. And now we have the honor of hearing from Alan Blinder, whose work in this area is well documented by the number of times he's cited in the paper. So Alan, the virtual floor is yours.
I'm going to share a document, share slides. Thank you very much for the invitation and the introduction. I'm not seeing my slides. Are you?
It says you're starting to share content. Long and variable lags.
Yeah. All right, let's see if this should work. Slideshow from current slide. All right, here we go. That's good now, right?
No.
No?
No.
Oh.
There we go. Perfect. Don't touch anything.
I got it before you. That doesn't usually happen.
Yeah.
So thank you, David, and thank you for the introduction. Thank you to the organizers of this event, and thank you to especially to Filiz and colleagues for this extraordinary body of work. I want to start with some very well-deserved praise, echoing a lot of what Rich Clarida just said. This is an impressive effort. More important to me than impressive and comprehensive, which it also is, was thoughtful. I mean, a lot of thought went into this big, carefully selecting these 225 criteria. That sounds ridiculous, but it's not ridiculous. It was thoughtful and even creative in places. Reading the paper reminded me of a flippant remark of a then junior colleague of mine many years ago at Princeton, who drew the distinction, he was a theorist, by the way, between economic theory and empirical work, with the emphasis on work. There was a lot of elbow grease that went into this effort by the entire team, and they are to be applauded for it. And as Rich said, I wasn't thinking of courses at Columbia, but I think this is going to be, I'm sure, this is going to be a rich and useful source for central bankers, researchers, and I guess I should add, given what Rich said, and teachers, both now and in the future. So congratulations to Filiz and the entire team. And thank you for doing this, 5 years worth of work. This is not a trivial task by any means. As a discussant, as an academic discussant, I felt it was incumbent on me to at least point to some, and I underline or italicized the word potential drawbacks. These aren't serious drawbacks, but things that are worth noting. Two things. First is the short time span, and I hesitate to say this is not a criticism. This is an enormous amount of work to do for this many central banks, even for 1 year. And they've done it for the entire, well, it's 11 years, 2007 to 2018. And I was enthralled to see the more recent updates of the Fed and the ECB. I'll come back to that in a second. But I want to note this is really not a criticism, but it's something to note when considering the time series aspect of data like this, or any data like this, ratings of central banks on anything. In central banking time, in most instances, in central banking time, 11 years is a blink of an eyelash. These are slow-moving institutions generally. And it is a certainty that you will miss important changes in frameworks by picking any 11-year period. So again, it's not a criticism, but just something to think about. And I'm going to come back to this with some illustrations later that are outside this time frame. Second, this is the professor in me. The three axioms seem to me a distraction, and I'm not sure they're axioms at all. And so the second point is about the English language or any language. The first point of the distraction is with 3 pillars, never mind all the sub-pillars, and 3 axioms. You've got already 9 cells, and I found that a lot to absorb as I read the paper. I was constantly thinking, where in this 3x3 matrix is something that crossed my mind. I don't think you need the axioms except as, so these are the axioms. These are what they call the axioms. Filiz showed a slide of the 3 axioms before, so I'm not going to read this. Again, she already put it up on the screen. My point about the axioms is that these are terrific. They're all very desirable. And you could call them criteria, features, desiderata. There are a number of synonyms for that in the dictionary. And they are absolutely relevant to appraising the performance on the 3 pillars. But as I said a moment ago, on the second part of my point, they're not really axioms. Transitivity or the independence of irrelevant alternatives and a number of other things are axioms on which you found a system. These are criteria, important criteria, desirable criteria. Absolutely. I don't think you want to ignore them. But this is mainly a presentation point that I found it a distraction from the main and important messages. I guess that's what I just said. Oh, yes. And by the way, I was wondering how to say IAPOC. Filiz did it. That seemed like a mouthful to me, and I just wanted to make the modest suggestion, if it's not too late, to find a shorter name like MPF index or something like that. Maybe it's already too late. Okay. Coming to a more substantive point, it's fine and nice and appropriate to enunciate and elaborate on the 3 pillars, but to my mind, the pillars are not created equal. And the most obvious point is that the communications pillar, which, by the way, as you see in the sub-bullet point, I think is very, very, very important. I've written a lot of this. I sometimes like to think of myself as the guy that first started screaming about central bank communication back in the 90s. So I yield to no one in the importance of communications. But communications are, to my mind, and I think to most people's minds, a tool for greater accountability. How do you hold your central bank accountable if it never communicated what it was trying to do and whether it succeeded or not? You remember the infamous Montague Norman, never explain, never excuse. You need communications for accountability, absolutely. And secondly, the so-called monetary policy effectiveness result, that you can better, you can do monetary policy better if you communicate more. This is the whole argument behind forward guidance, for example. So to me, communications are a means, a very important means. So I don't mean to denigrate communications, but the other 2 pillars are ends. We go back to here are the pillars. Accountability is an end in itself. You want your central bank to be accountability. And of course, good policy is an end in itself. Communications is a contributor to both of those. More controversial, I would say that good monetary policy strategy and tactics, the second pillar, may be more important to society than either of the other pillars. I hasten to add in saying that we want all 3. So I don't want to pose this as a choice. You can have either good monetary policy or you can have accountability and independence. No, you can have all 3. We want all 3. But I want to illustrate this and illustrate the point I made about small increments of time, but by looking at 2 Federal Reserve cases that are way before 2007. And I think these 2 cases will be familiar to everybody in this, when it comes to monetary policy, this is a sophisticated audience, so I don't have to tell you much about the Volcker disinflation and the perfect soft landing of the Greenspan Fed in 94, 95. Full disclosure, by the way, I was vice chairman of the Fed on this second episode, so you could take what I say about it with a grain of, well, with as much salt as you want to put on it. The point is that these were highly successful episodes of policy, but scored poorly. I think the Fed would have scored very poorly on the IA. How did you say that again, Filiz? YAPOC?
YAPOC.
So whatever it is, index.
We're going to call it the blinder index going forward.
No, don't do that. It'll get confused with soccer teams. Had this index been done for the Fed in 79 or the Fed in 94, the Fed would have scored very low, probably lower than most of those low income countries. So let me elaborate on that just for 2 minutes and now I'm finished. So Paul Volcker became chairman in August 79, following the episodes, not always happy episodes, of Arthur Burns and G. William Miller, and the Fed's independence was in some doubt. And I think that's one of the reasons why Carter selected Paul Volcker as a pillar. Volcker was the pillar of independence and strength and anti-inflation determination. Nothing in law changed. So you could look at every single bit of paper relevant to the Federal Reserve in August 79 and nothing changed, except the name of the chairman. More importantly, Paul Volcker, much as I admire him, he's one of the greatest Americans of his generation, I've always thought, was a big disbeliever in accountability and communication. I remember discussing with these subjects with him many times while he lived. I counted him a friend, and I never could persuade him. He thought the Fed was talking too much. He preferred, as it says here, to go in front of Congress and blow smoke, both literally and figuratively. That was his way. And furthermore, his announced conversion to monetarism in 1979, I would say, was neither transparent, coherent, or consistent with Fed policy, present, past, or future at the time. So very low marks on all of that. But of course, he did what he said he would do and conquered inflation, and the great moderation followed, leaving everybody happy with the Federal Reserve. Second episode was Greenspan's perfect soft landing in the mid-90s. Fed independence wasn't an issue then, thanks to Bill Clinton. When this first started, I'm not talking out of school here, I was in the Clinton White House and we saw him enraged at the Fed raising interest rates, but he just kept it to himself. He never went out publicly and beat on the Fed as his predecessors frequently had. So there fortunately wasn't an independence issue. On accountability, Greenspan was a big disbeliever in accountability. He didn't smoke cigars like Volcker, but he dissembled constantly in congressional testimony. Here's a quotation that probably most of you in this room have seen before. Characterizing himself, I learned to mumble with great incoherence. There's that pillar, coherence. He said that about himself, and he thought that was great. Did the Fed have a framework then? Well, I don't think so. Ricardo Reese and I, in the Greenspan celebration volume of the Kansas City Fed in 2005, called it the Greenspan standard, which meant the framework of the Fed was giving all the maximum amount of discretion to Alan Greenspan to do what he thought was right. And leaving aside the regulatory realm, which we're not talking about today, he was right a lot more than he was wrong. Communications, the Fed first started issuing statements in February '94, not before, but I've had occasion in writing a book to look back. Well, I remembered them, I was there, but I had occasion to look back at them in writing a book. They were either cryptic or misleading for several years. For example, whether we were tightening or easing, we always said we were promoting growth. That's just one example. However, the monetary policy that was pursued in that episode was very, very successful. So, finally, don't get me wrong, I don't want to go back to the dark ages. I believe that the axioms are things that are desirable for central banks, and the pillars are all very important, though not of equal importance. I'm using these examples just to make 2 points, which is that in many central banks, the bigger changes in the frameworks occurred prior to 2007. And in some, by the way, they may come after 2018. So it's great that this is going to be kept up. And the other point I was just making is that one of the 3 pillars may trump the other 2. So last but certainly not least, I want to congratulate the authors on a job very well done, and I hope they've broken out the champagne. Thank you.
Thank you.
I only see coffee, no champagne, but we work on that.
You don't have champagne at the IMF?
We will arrange.
We'll work on it. I think not before 11 o'clock. I have a lot of questions, but I want to engage the audience as much as possible. So I don't see any questions on the WebEx link. I think there's a Q&A tab on WebEx. If you're watching remote, you can put them in. Alan, if I might start, Alan, I wanted to ask you a question or two, and then I want to let Filiz respond. One question, Alan, is, of course, if we have philosopher kings as central bankers who always do the right thing, frameworks and don't matter, and if we could be assured that every central banker had the spine of Paul Volcker and the uncanny ability of Alan Greenspan to read the economy in ways that no one could understand, we wouldn't have to worry. But I wonder whether you think we might not have needed Paul Volcker if we had had a higher IPOC score in the years preceding Volcker.
It's a good and hard question. I'm still, yeah, you can.
You're good, yeah. Yeah, you're good.
I think we would have still needed Paul Volcker or somebody like that. If you understood the underlying macroeconomics, you understood that once inflation got that high and that ingrained, you were going to have to do some quite nasty things to get inflation back to where it was. A lot nastier, I might add, than Jay Powell is going to have to do now to get inflation back. And so a good framework is helpful, absolutely. I mean, I try to emphasize, I think about two slides from the end, I said, don't get me wrong, I'm not against these frameworks, and they matter. But I think without the right person in the job, you could have a very nice paper framework, but it will be hard to make it work.
And then I don't want to let you go without asking you what you think about the new Fed framework. How would you evaluate it? Was it a move in the right direction? And what would you do differently given what we know so far?
A couple of things. First of all, as you know, David, and I think a lot of people know, I tend to be on the dovish side of the spectrum. So the extra emphasis to the employment objective was something that made me smile, although it does have some difficulties, as we're seeing now. I was critical at the time, and I still am, although it's become irrelevant given inflation in the sixes by the PCE, of the vagueness of the averaging period. If you've declared that your objective is to get the inflation rate measured by PCE to 2% on average, but you've said nothing about when the averaging period starts or when the averaging period ends, it doesn't accomplish what price level targeting, its first and mostly academic cousin, was designed to do. And I think they miss, so I said that at the time, and I still believe that. The criticism when I leveled it at the time in 2020 seemed germane to what was going on then, given where inflation was. It's not very germane now. I mean, who cares now when inflation, I guess it just printed today at 6.3, the PCE, so it doesn't much matter. It needs to go much, much lower. But hopefully we'll get back to a point where it is relevant again. We'll get back in the twos.
So there's a request that the slides be shared with everyone, and I'm assuming that somehow the fund will figure out how to do that on the event page. Filiz, before I turn to the question, did you want to respond at all to Rich's quibbling about 0.5 or anything that Alan said?
Actually, I do believe that in one of the revisions, we get rid of 0.5, but it was a bit of a legacy thing there that it was an oversight on our part. So that that specific criteria was revised to have 0-1 scoring. But we do have a few cases where we have that not entirely 0-1, and we will take another look at to see how we can clarify it further. So on, I mean, first, I am really grateful for comments from both Richard Clarida and Alan Blinder. You know, I almost feel emotional that getting so many positive responses. And of course, this has been a great effort. We put a lot of thought on it, and the axiom criticism comment from Professor Blinder, I agree. I tend to agree. It was more of a methodological instrument that we use in order to be able to design a criteria in a way that is very objectively answerable from the public resources. So we didn't want to put together whether there was a numerical target and whether that numerical target makes sense. We wanted to give countries credit for having something, and with the idea that also capturing some of the less silent features in developing countries, because it is more of a continuum. These countries, sometimes they take baby steps. Maybe sometimes the first step is introducing a numerical target, and over time to refine it and explain it clearly and coherently within the monetary policy framework. So it was a bit of our attempt also to give credit when it is due, and the first improvement is usually in transparency, and that reflected also in the axiom discussion, but we will think a bit more on that.
Let me just interrupt. I don't think Alan was suggesting that that was not a good feature.
Yeah.
In fact, I admired the fact that you made clear that there's some things that you determine are good.
Yeah.
And it's a thing. He was just saying he doesn't like the word axiom.
No, I completely agree. It could also be that we use axiom for the lack of a better alternative too. So yeah, I take that. I also agree that all pillars are not created equal, but it's also that I want to leave that claim on whether one maybe matter more for inflation expectations or overall for the effectiveness of monetary policy to a more empirical work. Because we need to see whether actually communication matters less than the other two. In our understanding, I think I moved more in the zone that I see communication more of a very much of an integral part, and I'm sure that Alan Blinder also agrees, given that all his writings on communication, and I do believe that they are. I would give the same weight ex ante with the policy and operations strategy as well as independence and accountability. But I do think that it's an empirical question to see also at some level. And the good thing about this data is that we can actually answer these type of questions now using this granular data set. On independence accountability in the US, and Professor Blinder mentioned that the score for the US would look very low in the 70s. Well, it actually also looks pretty low also in terms of de jure independence and accountability now, because there wasn't much of a revision in the central bank law. However, of course, in terms of the de facto part of the independence and accountability, the United States as well as other advanced economies score much higher. In fact, there's an interesting trend in the sense that when you look at advanced economies, de facto independence and accountability is much higher than de jure across all countries, because sometimes the laws date back to 50 years ago. And this is very much in contrast to emerging markets and low-income countries, where sometimes with the help of the IMF, they revise their central bank laws so that de jure independence and accountability look sometimes very good, but then in de facto terms, the implementation is not there. So, so I think that also emphasized that, you know, the idea of looking to independence and accountability in both de facto and de jure terms, which we do here. So and on whether the monetary policy framework matters, I should say that when we started this work 5 years ago, even after the global financial crisis, people used to say that, why do you do this? Because inflation is everywhere low. So, you know, there are some cases that we all know that don't perform well, and so even there, inflation was not an issue. And now we have, after a COVID shock and after the war in Ukraine, now inflation expectations are again on the rise, and of course, it does matter how you conduct monetary policy. So I would like to think that it matters, but again, the index will probably allow us to look at some of these questions in more detailed way.
Yeah, you make a very good point on the, I was very impressed that you looked at both de facto and de jure independence. And 5 years ago, when you began this work, I would have argued that de jure independence in the United States was irrelevant, but we decided to test that for a while during the Trump years, so maybe de jure is important. Alan, I couldn't tell if you were trying to intervene or not.
I just wanted to say, just to clarify, no one should think that I want anything but tremendous transparency and communication. My point was only is that they were means to an end. Let me give you an example. To support life, humans need to eat protein. So we could be choosing between fish and meat and eating with our fingers, but having a plate and a fork is better. And that's the kind of thing that I mean. You know, the protein is the thing that's sustaining life. And the tools to ingest the protein are extremely important, but not ends in themselves.
But it also occurred to me that it's not independent of economic conditions, so that we learn during periods of very low interest rates that communication suddenly becomes a much more important tool
That's right.
of monetary policy. So there are a couple questions online, and then if anybody in the audience put your card up if you have a question. One is, so I think you spoke to this, but can we use this data for countries with a fixed exchange rate regime? It would help in identifying the existing gaps in their monetary policy frameworks, helping them in addressing these gaps before they move to a more flexible regime.
So we can use the assessment, the metric for countries that have some room for monetary policy. So it could be the managed floating, or there could be the bands, but we do require some form of room for monetary policy so that we can do the assessment. Because first of all, if you have a single currency board, you tend to not to have even a website for central bank. Even if you have, you wouldn't really explain what is your strategy, because your strategy is tied to a single exchange rate. So in this sense, there are cases in our assessment, and across the low-income and developing countries we look at in the paper, that manage their exchange rate quite heavily. And we do the assessment to identify and also perhaps contribute to their improvement, their enhancement of monetary policy frameworks in some ways that identifies the gaps and how they can move forward. And indeed, the ambition behind this 225 criteria is also to be able to provide specific guidance to some of these countries as they enhance their monetary policy frameworks. So it is possible, however, we do require that some room for monetary policy, which excludes hard pegs and currency boards.
And another question is, how do you envisage the IPOC index to be applied to our IMF TA work and engagement with country authorities? And tell me what TA work is.
Yeah, it's a technical assistance.
Okay.
So our colleagues go to central banks, and it's a very detailed engagement with them on how they improve the monetary policy frameworks. So we do think that there's a lot of overlap there. I think this effort of developing this metric and providing guidance on where there are remaining challenges and where they can improve is very important, and it could be used in the technical assistance with central bank in our guidance. And most importantly, I would like to point out that most of the things that we talk about are just monetary policy being clear, transparent, coherent, and consistent, which doesn't require large investment or money or in some ways, right? So in that sense, the framework really provides a good metric to think about these issues and how countries can improve their monetary policy frameworks, especially in low-income and developing countries.
Yes, please. And why don't you identify yourself for the people who are.
Financial stability. Secondly, when you just
Thank you. Yes, on the financial stability, we do not score the question on whether the monetary policy responds to financial stability or how it responds. We do record the information in the metric, but we don't use it for the assessment for two reasons. One is that there is not, so the country practices vary a lot, and there's no a really single idea there that is, or there is no consensus there that how they should be incorporating financial stability in the response to monetary policy. However, the framework does allow both the multiple tools and the multiple objectives. So if there's a case where a central bank identifies financial stability as one of the primary objectives of monetary policy and use macroprudential policy in an integrated fashion with the policy rate, then in the framework, these are accounted for multiple tools and objectives. And in that case, we would not only ask the clarity on the tools, but also ask how these multiple tools and objectives are balanced within the monetary policy framework. So when the trade-offs arises, for example, what happens? Also, what are the relation between two objectives, whether the trade-offs arises, and if they arise, how the framework would respond to these trade-offs. So that also goes to your second question, if a country adopts a new objective. Again, the framework doesn't take a stand on how many objectives you may need to adopt. However, it does ask you the transparency on the objectives, as well as a clarification on why do you need two objectives and how you balance these two objectives. So this is how the continuation are provided in the framework.
So when you say you record the financial stability, you mean if I go to your website and look at the individual country data, it will tell me whether they have a financial stability mandate, even if it's not in the index number?
No, you will need to contact me for that. And I will give you the answer.
Provide your phone number?
Right.
But I mean, it did strike me that it, as a side, given all the work you're doing, keeping track of where, if does a central bank have a financial stability mandate, and going forward, does a central bank is it asked to take account of climate change?
Right.
Will be interesting questions going forward, even if you can't put a number on them.
Yeah, right. I completely agree. Indeed, we do report not only the financial stability and all the other mandates of the central bank, whether there's another function of the central bank, outside of the central bank, inside of the central bank, whether they have a decision-making body together. So those are all recorded. But again, here we only focus on monetary policy function specifically.
Right.
And
so can you explain, so in the United States, the central bank mandate is price stability and maximum employment.
Right.
So how does that work in your index? How do you handle the trade-off?
Right. So in the United States, in 2012, when they put the long-term strategy and goals document, there was a very clear explanations. You may remember this bullseye
Right.
type of graph, where they show when the different objectives may be in conflict with each other and how the monetary policy could respond to that. So this is exactly mapped in our framework. So if you have multiple objectives, you can have multiple objectives. You need to explain them very clearly in a transparent manner. And you need to tell us why do you need two objectives and how you balance them within the monetary policy framework.
I see. Please.
Thank you. I'm Jada Owner from the IMF from Western Hemisphere Department. First of all, thanks so much for this wonderful presentation, and really congratulations to Filiz and the whole team for a monumental work. I have two sort of nebulous questions that are forming in my head.
Don't oversell here.
One is about credibility, because it's hard to think about monetary policy without thinking about credibility. And the other is the integrated policy framework, which is a new policy framework that was developed and also drew on this work. So when it comes to credibility, the question that I have is, it sounds like this index, and we've had the benefit of discussing in the past, the index is sort of measuring or assessing monetary policy frameworks against some sort of ideal. So, perfect independence, great accountability, clarity in the legal framework, perhaps alignment of de jure and de facto frameworks, not entirely sure, but please correct me if I'm wrong. So it's measuring everything against some ideal. And I'm wondering what benefit there is to a central bank from achieving or trying to get closer to that ideal. And that's where credibility comes in. Presumably, that's a very important end for a central banker. And maybe it's measured in the effectiveness of monetary policy. Perhaps for an inflation targeter, it's about expectations being very well anchored. So I'm wondering how the index, in a way, motivates central bankers to achieve higher assessments, what benefits there are, and perhaps that's an area for further research. What are the gains from having higher index? You showed the negative correlation with inflation expectations. Perhaps in itself, it doesn't address the credibility question, because that's more of a, whether it's anchored given, new data releases or policy statements. So a more dynamic, perhaps, analysis would answer that question. And that's more relevant for inflation targeters. So for those who have more managed regimes, I'm wondering what the benefit of that higher index assessment is. So that's the credibility question. And then on IPF, the Integrated Policy Framework, I think you kind of answered it already in responding to my colleague from the Fed, who was asking about, changing mandates. But here I'm thinking more about changing ideologies. Over the last 10 years, the fund has changed its thinking about capital controls. If our idea about that best practice changes over time, how would the index get adjusted? I think in a way you kind of answered it by, clarity and so on, but just wanted to pose it as whether the yardstick could also be changing. Thank you.
Yeah, thanks, Jada, for the great question. So the first on credibility. So we do not actually, on purpose, we do not compare YAPOC with inflation outcomes on a yearly basis. So what we compared with was the medium-term inflation expectations and also the inflation outcomes over a medium term, because of course, as we all know, year-to-year inflation outcomes may change depending on many different things. And what we essentially mean by anchoring inflation expectations is how a yearly inflation outcome doesn't change the medium-term inflation expectations, right? So there's more of a formal definition of anchoring. And we did those exercises too. And it is conceptually at least very clear that having a clear, transparent, coherent, and consistent framework should have an impact on how the public perceives the monetary policy. Because at the end of the day, they may not be too focused on whether the policy rate is going to be increased 25 basis point or 50 basis point on each and every FOMC meetings. But what they want to know is that the central bank is there to act. They know they are committed to their objectives and numerical targets that are mandated by the legislative branches of the government, and they will be changing their tools and adjusting their strategies as the time comes forward. So I cannot really imagine running a credible monetary policy framework without having, credible monetary policy without having a sound monetary policy framework. Now, in history, you may get lucky that even without having a good monetary policy framework, maybe your inflation doesn't increase that much, or there could be other reasons for it. But in general, I think it cannot hurt to have a sound monetary policy framework. And that also links to your second question. It's not like we are here painting a frontier for all countries to achieve. And the idea around the axioms was also the fact that if you focus the discussion on transparency, coherency, and consistency, there are many things that you can achieve, and there are many roads that you can take while you are conducting a monetary policy in a sound manner. That is the idea behind allowing flexibly having the multiple objectives and instruments in the monetary policy frameworks, multiple tools in the monetary policy frameworks. But of course, you need to be coherent what you are doing within the framework as well. So for example, in our framework, we are not fixated on inflation targeting. We are not fixated even using the interest rate as a tool. However, we are looking for countries to use some tool in a coherent way in order to achieve some medium-term objective and numerical target. Specifically on your question on integrated monetary policy frameworks, and indeed we had some discussions earlier on this, so thank you for that also. So we know that there are countries that already integrated some of these tools into their monetary policy frameworks, such as Indonesia, that explicitly talks about an optimal mix of frameworks, including foreign exchange intervention and capital flow measurements. So now in our framework, that would mean that the country have 3 different tools, and then they will need to explain within monetary policy strategy how they use these tools in which occasions, and how they balance together, and what type of conflicts may arise, and if they arise, how they will be addressed. This is the only logical thing that we ask within the monetary policy frameworks. So in that sense, it's not an ideal, it is designed in a way that to capture that moving ideal of the monetary policy frameworks. Now, of course, that we might have other surprises, and maybe at some point we will need to revise that, but not for the reason that they adopt other instruments, other tools for other objectives.
And do you have more work in mind along the lines of that inflation expectation charts you showed to help me understand whether we get good outcomes from the frameworks? Is that
right? Exactly. Yeah. I mean, we get good outcomes from the framework overall, but also which parts of the framework, as Ellen Blinder alluded to, maybe some parts matter more than others. And also to see, what type of information we get, both for a cross-country deviation in inflation expectations right now, but also going back to the discussion of managed versus flexible exchange rate regimes. For example, there was this view for a long time that you either go fully fixed exchange rate regime or flexible. Now, of course, we are discussing this also at the IMF within the integrated policy frameworks. So maybe if you can have a managed exchange rate regime in a sound framework, and how we can do this and think about this. So we want to go to that direction and challenge a bit that earlier literature on the bipolar views on exchange rate regimes also.
Interesting. Before we close, Chris or Henry, do you want to say anything?
Yeah, I just wanted to say a few things, pulling a bunch of the comments together. So this was a huge exercise on measurement, right? So we tried to put all the pieces together. Filiz talked about 225 measures. And then, of course, it was a big measure. It was a big effort on concept. And we felt that we had to have the pieces through measurement and then offer a way by which we pull everything together in a framework. But given how granular everything is and how available now is, we are very much open to the framework in the sense that we put something out there, but we wouldn't be surprised that this will be modified with time. And we welcome, of course, students, policymakers, to not only take what we give them for granted, but also challenge it. So we are very flexible on that dimension as well, just because everything is available and everything is very transparent. The second point that I wanted to make is about sort of this issue about axioms that Alan mentioned. And of course, again, we struggled a little bit on what to call these things, but I wanted to bring a new dimension that I think was not highlighted sufficiently in this discussion, which was, we care to service the advanced economies with this index, but also the rest of the membership. And there is where we see major gaps, and there is where we see how, for example, what we call axioms can be used by teams as they go for discussions with authorities in lower income countries. And of course, there, the room for improvement is glaring. And we thought that this way of organizing the measurement was the right one. I like very much Jada's point on credibility. It's something, Jada, we could do as we move ahead. For example, we could do a survey. I mean, in theory, we can relate our framework with credibility, but in practice, we don't know, right? So we could easily do one of these surveys that are very easily done now by subcontracting and trying to provide an answer to that. We think, in theory, we think that they would relate, but it would be also be good to see what aspects of the framework would enhance credibility. Thanks.
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 Andre?
No.
No, not here?
Henry is not here.
Okay. The cards are turned in a way that make it impossible for me to see who's saying. Well, unless you have some final thoughts?
No, thank you, David. Thanks for coming, and thanks again for Richard Clarida and Alan Blinder for their comments. We will think very carefully about them, and also for discussion on the floor today. Thank you so much. Please check out the data. And also, I would like to thank our team, particularly Maria Rosaria, Marina, and Ömer for putting this event and also working on the data tirelessly. Okay, thank you.
Right. I want to thank everybody for participating, particularly the people who asked questions. But as we had the conversation, I was just struck by how much work is involved in this. And it's very easy after it's all done to say, so why didn't criteria 4.132, why don't you have a different thing? Yeah. So I hope you will take the constructive suggestions as not undermining the incredible, impressive work that you did to put this together.
Thanks.
So with that, thank you all and have a good and safe day, and for those in the States, a good holiday.
Thank you. Thanks.